All right, welcome back to another edition of Intermediate Accounting 1. We're going to jump into Chapter 10, and we're only going to be worried about learning objectives 1, 2, 3, and 5 in this chapter. So let's go forward. So, Chapter 10 is all about property, plant, and equipment, otherwise known as PP&E. So if you hear me use the phrase PP&E, just realize that I'm talking about property, plant, and equipment. Some features you need to know about PP&E. One is sometimes it's referred to as plant assets. Another term that is used often is fixed assets. So if I say the phrase fixed assets, plant assets, or PP&E, just realize that I am talking about property, plant, and equipment. Another key feature about PP&E is that this type of asset is long-term in nature. I think most of you know about that, but also realize it's usually depreciated. Another feature is that the PP&E possesses physical substance. So another way of referring to that is PP&E is tangible, meaning you can touch it, you can see it, you can smell it, in fact. Another key feature is that PP&E is used in operations. It's not something that we hold for resale. Inventory is something that we hold for resale. Something like trucks, UPS trucks, those are fixed assets or vehicles that we use in our day-to-day operations to help us generate revenue. So whenever I refer to PP&E, just realize I'm talking about land, buildings, and equipment primarily. Sometimes you may see the phrase machinery or furniture or tools. That's all in general just equipment. Let's talk about the acquisition cost, or whenever we purchase PP&E, what do we have to worry about in terms of the expenditures and how we record the purchase of, say, a pizza oven? Well, the number one thing we have to worry about is recording things initially at historical cost. So historical cost, we know, is the amount that we pay when we initially purchase something. Historical cost measures the cash or cash equivalent price. Primarily, that is what we're paying at retail. So if I say I spent $1 million for this piece of equipment, that's referred to as price. And that is the cash or equivalent price of obtaining the asset and bringing it to the location and condition necessary for its intended use. I know that's a long phrase, but just realize here are the key phrases. It's a price we pay to get the asset, to bring it into its condition and ready to be used. That's essentially what historical cost is all about. So the main reasons why we use historical cost, well, the biggest one is that it's reliable for sure. We can actually look at an invoice and say, hey, that's what we paid for it. We know that things depreciate or lose value over time, but that's another topic we'll deal with in Chapter 11. Companies can recognize gains or losses only when the asset is sold. So even if, say we have a building, or say we have a building and it depreciates in value, we'll record that. It may be the case that a realtor comes in and says, hey, the value of our building is actually much higher than what we show as net book value. But we don't worry about that stuff. We don't worry about the fair value of land, the fair value of a machine or piece of equipment. We simply keep things recorded at historical cost. Whenever we sell fixed assets, that is when we worry about any gains or losses due to whatever the fair value is at that time. So now let's move on to the different types of expenditures we can possibly make when we buy, for instance, land. Land's a big one. First of all, we want to include, as part of the cost of land, any and all expenditures necessary to acquire the land and make it ready for use. Basically, that's historical costs. These costs typically include, obviously, purchase price. But other things it includes are attorney's fees. Lots of fees associated with buying land. If you haven't bought a house before or bought land, you'll know what it's like. It's insane the amount of fees that you have to pay for that kind of stuff. Another type of fee is recording fees, title fees, etc., etc. Another one that people tend to forget about are the costs of grading, filling, draining, and clearing land. So we buy a piece of land, but we need to flatten it out. We need to dig it up. We need to make it even. And these costs also include the cost of removing old buildings. So if there's a building on there and we don't want it, we may pay for it. But if we demolish it, we have got to include the costs associated with demolishing that building as part of the cost, because we need to get the land ready for use. That building is in the way, so boom, bulldoze that sucker. Whatever the costs are, that's part of the cost of land. We got to get the land ready for use. Another aspect, assumptions of any liens, mortgages, or encumbrances on the property. So typically whenever you buy a house or buy land, you always check to see that the person who owns the property, there are no outstanding legal liens, i.e. claims of ownership from some third party, because that can get you in trouble a lot of times. But usually in the case where you're buying something, these kinds of things are not part of the purchase price. They're the responsibility of the seller. But if we do assume any of those things, that becomes part of the land cost as well. Another thing to realize is that any land improvements that we make, especially those having an indefinite life, because land has an indefinite life. So any type of special assessments, you ever see that phrase, special assessments, that also needs to be included as part of the land. All right, here's an important thing to keep in mind. What type of expenditures are not included as part of land? Any type of improvements with limited lives, such as private driveways, walkways, fences, parking lots, right? That stuff wears out over time. So those things definitely do not have an indefinite life. They have very limited lives. So we don't want to include those. These things that we put on the land will record separately as land improvements. So a parking lot, that's a separate T account. Separate T account. Land acquired and held for speculation is classified as an investment. We're holding on to it. We're not going to build on it. We won't build on it. We're just going to hold it, wait for the price to rise, and then sell it off at a higher price. Land held by a real estate concern for resale should be classified as inventory. Yeah, if we're in the business of buying land and selling it on a regular basis, then it's not necessarily an investment. It is part of what we do. So we are in the business of selling land. It's not an investment. It is what we do. We are landresellers.com, right? What about cost recuperation? So remember how I told you about those buildings, like if we demolish a building. Well, let's say there's some sort of, when we go inside the building, maybe there's a bunch of stainless steel that can be repurposed. Well, if we want to use it, we'll hang on to that. We'll record that separately in a different type of a T account. But let's say there's some type of special fixtures or copper. Copper's a big one. If we want to yank it out of the building and sell that copper or sell that stainless steel, that can be considered part of cost recuperation. And what we do in that case is we reduce the cost of land for any money to receive from salvage. Salvage, say, from copper piping, because that's always in high demand. Copper piping or any type of stainless steel, that's a big one as well. Now let's talk about the cost of buildings. Buildings, pretty much any type of expenditure related directly or to the acquisition or construction of the building, those are things are all what are called capitalizable. By the way, that is a term that I forgot to mention earlier. When we're talking about capitalizing things, right? Say, for instance, we know we spent money, so we credit cash for something. The question of this comes down to, what do we debit? So if we're talking about a cash item that we spend on buildings, that sometimes is called an expenditure. An expenditure is basically a cash payment. But what do we do with those expenditures? Well, there's two things we can do. We can either capitalize them or expense them. When we're buying things that have a long-term future economic benefit, such as buildings, we want to capitalize them. So the idea here is that when we buy a building, we're going to debit an account called building, and probably the address will be attached to that as well. And that amount, whatever we pay for it, that becomes part of the cost of the building. The fact that we're debiting the building account means that we are capitalizing the cost that we pay or the money that we spend on that asset. If we have no value to this thing, if there is something that we're spending that is just incidental, such as heating, cooling, utilities, things like that, anything associated with the building after we're done getting it into place, we'll just call that, say, for instance, utilities expense. And that amount is just something that we quite literally call expensing. We're not capitalizing, we are expensing. So there's only two ways we can really classify these things. Either we're capitalizing into the asset account itself, or we're just going to expense it right into the income statement. Now, rarely when we're buying a building, rarely is it perfect and ready to move in. There's a lot of things we have to do to prepare a building. Once people leave, it's usually just gutted. Okay, so any type of materials, labor, overhead costs to either build the building or get it fixed up based on what it currently is, those things are all capitalizable. Professional fees, building permits, anything related to getting the asset in its place ready for use, those things are all capitalizable. Check, check. All right, what about equipment? Now, equipment is a very broad category, but just keep in mind whether we want to call it a machine or piece of equipment. Sometimes we can call vehicles our equipment too. Whether or not we call these things separate T accounts, realize that anything we pay to purchase the item, to ship it in, sometimes if we're buying specialized equipment or vehicles from overseas, we have to pay for the shipping freight, which is very expensive, to bring it over into our part of the world. Any type of insurance while the thing is in transit, not while we're using the thing, while it's in transit. Those things are capitalizable. Costs of special foundations, if required. We got to say, if you ever go to a brewery, for instance, if you go to the brewing floor, you see that they have these large, 3-foot tall, maybe, stainless steel fermentation tanks. It looks like just big vats, if you will. Well, for some breweries, they have to reinforce the foundation to handle the weight that is put in place, the weight from the fermentation tanks, because those fermentation tanks tend to stand on 4 pegs. So if you imagine they got 4 pegs like this, they kind of stand up like this. And so usually there's some sort of cone foundation and they kind of goes up like so. I know this is a terrible drawing, but think about the pressure underneath those pegs, the standing tall, right? There needs to be a lot of reinforcement to the foundation just to hold that sucker in place. Otherwise, those fermentation tanks will sink right through the concrete. So any money just to get the foundation in place, that's also something we can capitalize as part of the overall equipment itself. Assembling and installing costs, yeah, and testing. Don't forget that as well too. Assembling and testing. Especially if we buy a computer equipment, we need to test it, make sure our server is working. Cost of conducting trial runs. That's another way of saying testing. What about self-constructed assets? We need a specialized piece of equipment. There's none that currently exists on the market. We need to build ourselves. And if you're a small business owner, you have to kind of get used to being, innovative with your operations. So, self-constructed assets, any type of materials we use, lumber, copper, anything to get the thing built, any type of direct labor, that can be capitalized as well. You have to be kind of reasonable. If you're the one who's building this thing, don't all of a sudden say, well, it's $1,000, my hourly rate is $1,000 an hour. Okay, there's always this potential that you might get audited by the IRS, and they don't like to see you being extravagant with certain estimates. Overhead, so materials and labor, overhead, any type of lighting, any type of heating, right? Those things are sort of general, not directly related to the asset. Those things need to be allocated to the overall asset as well. So assign it either assign no overhead at all, or assign some portion of your utilities to the construction in process. Those ways tend to work fairly well. Most companies tend to do this method because they figure if it takes us 6 months to build a piece of equipment, all the heating, all the cooling, all the water, any type of property taxes, all that's overhead, considered overhead costs. That stuff should be capitalizable. So rather than just expense those and reduce our net income, let's capitalize them, put it as part of the cost of the asset, and we'll just depreciate it over the life of the asset. It makes a lot of sense to do that. So here's a good checkpoint that we can stop and sort of take a look and see if we know what's going on here. Determine out the following expenditures, cash payments, should be classified. Either land improvements, or buildings. In other words, the T accounts. Which T accounts? So over on the right-hand side, money borrowed to pay the building contractor. Well, if we borrow money, we know that that's just going to go right. We get cash. We're going to credit notes payable in that case. So we get the money, but we haven't spent any money yet. So let's just go ahead and debit the cash, credit the notes payable liability account. What about payment for construction from the proceeds? So let's say we use the cash from the loan to start building something. Well, put it into the T account for the buildings. What about the cost if we use some cash to purchase land, to fill land or clear land? Well, that's going to be part of the cost of land overall. If there's any delinquent real estate taxes on property assumed, typically what happens if you ever buy a house, usually what you do is you can ask the seller to put extra money into the escrow account for any property taxes that have been incurred but not yet paid. That's a fair thing. Otherwise, when you buy a house, realize there's probably some property taxes in arrears. You'll be responsible for paying those in addition to the property taxes since you moved into that house. Overall, if you pay for those property taxes, you're going to go ahead and include those as part of your land. Premium of a 6 month insurance policy during construction. That is the key phrase. Not just general insurance, but just the insurance paid while we're getting the asset ready to be put into place. That's going to be capitalizable as part of the building. If we get any type of money back, a refund, go figure, a refund from an insurance company, who knows? Maybe we finish the project early, 1 month in advance, and we contact the insurance company and they say, yeah, we'll give you that money back. Well, you need to take that money. If you get any type of refunds, okay, you need to remove that out of the cost of the building. Why? Well, because essentially you got cash, right, from that refund. So what should you do? Credit what? A gain, revenue? No, it's a refund, okay? So just if you initially put it into debit building, credit the building. Pull it out of there. Land improvements, cost of parking lots and driveways. We're going to keep that separate from the land itself. Commissions feed paid to real estate agencies. That's part of the land. Installation of fences around the property. Fences, parking lots, driveways. That's all land improvements. Cost of raising and removing a building. Cost of raising and removing the building. If we don't want the building, we're getting rid of it. Guess what? That's part of the land. Cost of real estate purchased as plant site. Land was $200,000. The building was $50,000. So, typically when you buy a house, you're buying both the land and the structure in place. And by the way, when you pay property taxes, you pay it. The property taxes are assessed on both the land and the structure. So in that case, we just say, hey, that's any type of cost we paid for to buy real estate. That's just part of the land. But primarily, we just focus on the land and keep the building separate. Proceeds from salvaging the salvage the salvage or demolishing of the building, that if we get any money back, this is money back. If we get money back from demolishing something, that should be reduced to the land T account. Architect's fees on a building, well, that's going to go right into the building. Cost of trees and shrubbery. Now, some people look at this and say, that's just a land improvement. Well, here's the thing. When you install a tree, okay, that sucker's going to start planting roots. And generally speaking, that's going to be something that's permanent over time. I don't want to have you guys worry about having to make judgment calls about this. So if I say something that we put into place is permanent, okay, unlike a parking lot, which can be tore up, trees, consider those permanent. That'll just be part of the land overall itself.